What are we going to be talking about on SPY, you think, today?
Uh, Hold on a second. Well, do I have to grab control of the
Yeah, no,
screen?
you can get the screen back. You can grab your screen back.
Okay. Um, let's come back to the single leg dashboard. We'll just discuss this report over here. And one of the things when we analyze options is that when you see option contracts trading, sometimes a trade you could enter in a trade that's multi-legs. Like if you enter in a call spread, right? When you could enter it as a multi-leg trade, meaning that both sides have to get executed, right? That's the condition. You could enter a three-legged trade or four-legged trade, like when you do butterflies, or you could do iron condors. So when you enter in those types of um, orders, they could they'll get executed, and the multi-leg trades will even have a indicator that this was part of a multi-leg. Let me show you how that would look. If I go to option block trades, just so you see the conditions here. So here are different trades in options. You could see here you have different symbols. This is the option contract. It'll give you the expiration, put, strike. But if we come over here, we could see that there's conditions here. So see multi-leg. So multi-leg means that this trade was part of a multi-leg trade. There's another leg to that trade, right? So, and here we could kind of just see these probably two are related. This call and put, they both trade on the Amex at the same time. So these were probably the ones that were related, but then you have auto execution, you have regular trades, intermarket sweeps. You get all these different conditions. And when we analyze the options, we want to sometimes get more granular and separate them, put them into buckets. So we could analyze the multi-leg trades separately, and we could take the single leg trades and analyze them separately. Okay, so that's what we were doing here in SPY when I went to the single leg dashboard. Let's go back here, options. So here's the single leg dashboard. Multi-legs are over here, but let's go back to the single leg. I'm going to click on that. We'll bring up this dashboard here. And now we have just these single leg trades that we put into a bucket, and we're going to analyze from different perspectives. And you could see here that we have different analytics, okay, on these. So first, over here, we see the number of contracts, 6,900,000, almost 7 million. And that's out of a total of 7.7 million. So you could see the vast majority of them are single leg trades. There's still a significant amount that were multi-leg trades over here, 700,000 yesterday, but most of them single leg trades. And this is the breakdown between calls and puts. 48% of them were calls, 50%, 52% puts. And here we also have these interpretations that we have an algorithm look at how the trades, how the executions compared to the markets and surrounding data. And we try to interpret, were the incoming orders sell orders or buy orders. Okay, so you got market makers, you got market takers. Makers are people providing liquidity, takers are people who take the liquidity, grab the order book and so forth. So here it looks like, they were pretty balanced, 50%, 49%. So those were pretty balanced yesterday. Then we have here the top 5 most active options. And these are just the single leg trades. It wouldn't include the multi-leg trades. And it gives you an idea where most of the trading in single legs are concentrated. These are the top 5. Here we see July 29th, expiration, 546 strike, 409,997 contracts traded for the VWAP price, average weighted average price, 90 cents. Okay, so there are different prices it traded at, but that is the volume weighted average price. Okay, which means that you take the trade, take the price that it traded at, multiply that by the volume, do that for each trade, then sum them up and divide it by the total volume. That's your VWAP price. And here, just eyeballing it, top 5 most active, looks like they were all 0 DTs. Yesterday was July 29th. The 5 most active options were all July 29th. It was a mix of calls and puts, right? So call, put, call. And you could see that the strikes themselves were between 544 and 547, which, just looking at yesterday's range, 542, 547, just looks like that those 0 DTEs were the most active, and that the strikes that were trading were, basically around where the stocks were probably fluctuating at that time. Okay, so that's kind of the takeaway from there. And of course, once the market opens, we're on a 15-minute delay, but once the market opens, we'll start crunching the numbers, and these will be updating. So throughout the day, you could also just kind of track what's going on, SPY or any other stock. And if you click on this, it'll take you to the options chain. You can analyze that option further. But let's go on to the next analytic here. And this is also an interpretation. So this runs an analysis and creates an interpretation. It says, well, what if we took the volume? So we took all this volume, 6.9 million. And then we made interpretations of incoming orders. How are they? Do we think there's incoming orders are call buyers, sellers, put buyers, put sellers? Well, we have all these trades. How do we convert this volume into a different analytic in terms of Greeks, right? So the Greeks are letting us know the risks exposures of these options. So the risk exposure, let's say in delta terms, right? You could have an option that is very deep in the money and its delta is high. It'll move 1 for 1 with the stock. So it could have 100 delta. Basically, so deep in the money that if the stock moves up $1, the option will move up $1. If the stock moves down $1, the option will move down $1. So it has delta. But you could also have an option that's a penny and it's so far away out of the money that the option will move very little if the stock moves up $1, or maybe not at all. You could have a penny option that's so far out of the money that $1 move in the stock in SPY will not impact that option at all. It has to really, the stock has to start rising significantly until the delta of that option starts kicking in and it starts going up. So that's the delta. So if we wanted to get an idea, how these options are trading incoming, we could take those deltas, make our interpretations, and then get an aggregate as a whole. So here it says on aggregate, we have -2 million deltas in SPY. Okay, so that's the converting the option volume into delta volume. And keep in mind, this is our analysis and interpretation. Now we could also have volume converted to gamma. So what the gamma does is it says, well, how sensitive are these options, uh, or how sensitive is the delta change of these options? Okay, so if you have an option that has a big gamma, it means that once the stock moves, you're gonna, even if you're delta neutral, you're gonna get your deltas are going to increase or decrease, right? Because go big positive or go big negative. So this is showing the gamma, and what a short gamma means that if the stock is moving up, people who are short gamma will have to buy more stock to hedge their positions. If the stock is going down and if you're short gamma, you'll have to sell stock to hedge your positions. And if you're long gamma, it's reverse, right? If you're long gamma and the stock is going up, that means you'll have to short stock or sell stock. And if the stock is going down, you're going to have to buy stock. Okay, so that's what the gamma is on telling you how, those positions on balance, look like. Now you got the Vega. And the Vega, so short gamma just implies that there's more selling, right? To get short gamma, you're selling options. To get long gamma, you're buying options with gamma, okay? Now, and this is kind of consistent in SPY. This is like very, typical, because I think that there tends to be lots of, around the zero DTE options, a lot of, selling looks like from day to day. Not every day, but it seems like, more often than not, we do see more selling. Those could be also hedges against other things. So keep in mind, like SPY, this is a S&P 500 ETF index. So there's so many different strategies around this, with hedging and pairs trading and all that. So let's go now to the Vega. And what the Vega implies is that when you're selling options, right? When you're selling options, well, you're short implied volatility, because if implied volatility goes up, the option will go up and you're going to lose. If the implied volatility goes down and the option premium goes down and you're shorted, you're going to win. Okay. And on the opposite side, if you're long, you want it to go up or down. So short Vega, would indicate that more sellers of options. And that's what would kind of fall, why these kind of match up, which would make sense. Now, this isn't a large Vega, negative 28,000 on balance, which also makes kind of sense because it seems like most of the volume is probably in the zero DTs at the time of the trade. And the Vega of short dated options are not the same as a Vega of a long dated option that has a lot of premium. So as you go out further in time, the sensitivity of the options to an implied volatility change increases. Because like, think about it, like once the option is zero DT or expires, it has no more implied volatility, right? It goes to parity, right? There's not a lot of time premium in it. And then finally, this is the theta. So the theta is telling us in aggregate, well, how much decay will these options, on balance? So if you're short gamma, you'll have a positive decay. If you're long gamma, you have a negative decay. So why is that the case? Well, if you're short options and nothing happens and the options decay, you're expected to make the difference, right? If you're short an option at 1,000 and it decays by 10 cents, well, now you got an extra 10 cents. So these would be opposite of each other. You got negative gamma, positive theta. If you had a positive gamma, it would be a negative theta. Because if you long options, all right, if you long it for dollar, it decays, and now it's 90 cents, well, you lost 10 cents, right? Because you're long gamma, short theta. So those all make sense. Then coming over here, this is a volume breakdown by trades conditions. And it gives us a sense of how people have been executing trades, what type of conditions were attached to the trade. So here in auto execution, most of them, 59%, hit the auto execution, which indicates that the trade was matched up electronically within the exchange's matching engine. So there's a buyer and a seller, and they matched up inside the exchanges matching engine. It could be different exchanges. Then you got this price improvement auction, 31%. And what this is indicating that when you enter in an order, and since most orders and trades are done electronically now, the exchanges themselves have what's called like a price improvement auction. So let's say the bid is $1 and the offer is $1.10. Well, now you have this market, and what if you want to buy it and you're willing to pay $1.10? Well, when you enter it in, and let's say it goes to a particular exchange, it could be CEVO, Amex, Arco, whatever. When you enter it in, that order could get flashed internally to the market makers and the specialists and say, I have this order to buy for $1.10. But before it's executed, would you be willing to give it a better price, like $1.09? So what it's doing is it's flashing it so people may compete to sell it at a better price, right? Because think of it, you have competitors to buy, competitors to sell. And sometimes when the market maker, they'll, even in a second, because it's done electronically, maybe they would be willing, their algorithm or whatever is willing to improve it because they have some in inventory or hedges something off at that moment, or they see something that they could spread it off. Whatever it is, maybe they'll say, yeah, I'll do it for $1.09 or I'll do $1.08. So it forces competition for that second. Okay. Maybe don't get a price improvement, but what it does is it tries to create more competition so that incoming order may receive a better execution. Sometimes it might happen to you. If you guys ever entered in a trade, buy for this price, and then all of a sudden, oh wow, I was willing to buy for $1.10 and but I ended up buying it for $1.08. So I got a price improvement, right? You did better, you saved money. So 31% of the orders hit the price improvement, which kind of also indicates that, hey, there's a lot of room in trading options in this SPY to get a better price than even the prices that are displayed, right? Because the prices that are displayed are firm. Once they're displayed there, and if you're the first one to grab it, the other side, firm means the other side is obligated to trade at that price. So if you put in a limit order to buy at a certain price, if somebody hits your limit order, that's it, you bought it. It's not like you negotiate from there. That's firm. You're obligated to buy it at that point. So that's the price improvement. Then we got 10% intermarket sweep. The intermarket sweep, that's another type of order condition, and that's for orders that are typically trying to get immediate execution. It's a little bit more aggressive. And what it does is say, I want to, let's say, buy or sell this option, and I see liquidity on different exchanges. So let's come down here. You see there was all these different exchanges that have liquidity, different offers, let's say. And according to the rules, right now, if you enter in an order, let's say you want to buy 100 contracts. If you enter in an order, the obligation is to go to the exchange with the best price first. And once you exhausted that price, then you go to the next exchange with the best price and so forth. So let's just say you have an exchange that's showing the best price, but it's only one contract and you need 100. And the next best exchange has 99 available, but it could be at a higher price. So if you enter in that order, it's going to go to the first exchange, grab that, then it's going to check, are there any other exchanges with that price? No, go to the next exchange with the best price, grab that, and so forth. But as you're doing that, the price of the stock could move, right? And and those offers can move up or disappear, or somebody could grab it in front of you. So an intermarket sweep order, what it says is, I want to bypass this Reg NMS rule, right, of going to the best price first and go simultaneously top of book on multiple exchanges. So I don't care the order. I don't want it routing around, and as it's doing that, the market moves against me. I want to go simultaneously. Let's say I want to go to SIBO, Amex, ARCA, whatever, simultaneously. Go out to those individual exchanges and grab the liquidity. And to do that, you say you have to designate it in an intermarket sweep, which allows you to bypass those Reg NMS rules. So 10% of the orders here were intermarket sweeps. Okay, and then finally, floor trade. This is a way to trade using human touch. Most volume at this point is all electronic. You guys are probably only doing electronic orders, which you log into your broker, you put your order in, and they just route it out. However, there are certain instances where a trader, it's typically like a bigger trader, says, okay, I have either a complex order that I want to do, with multi-legs, or I want to negotiate a better price, but I have a big order, or I need more liquidity that's displayed, and I need to go and find that liquidity from counterparties that may be interested but not currently displaying liquidity. So what you would do is call a broker who specializes in that, knows counterparties to contact. It could be market makers, specialists, could be other brokers representing other bigger customers and so forth. So the floor brokers have their networks, and they go and try to negotiate that trade. And if they negotiate that trade and there's a matching, then they'll do the trade, and then they will put it up on the exchange, and then we'll see it. So that's it's called floor trade, but that's a trade that's done with human touch. And yesterday we have it at 0. There could have been some, but it's just close to 0. Right? Doesn't mean there's none, but we just round these percentages, which means there weren't that many percentage-wise. But all right, well, we're right up at 9:30, so I'm going to stop right there.
Awesome job, Dima, as always. You have a great day, my friend. Everyone, thank you for joining us. Great job, buddy.
All right. Thanks, Will. You too. And thanks, everyone, for joining. Stay safe out there. Hope to see you guys tomorrow.